The valet lanes were empty. That was the first sign. Opening day at the Fontainebleau, Las Vegas, December 2023, and the arrival circle stretched silent under Nevada sun. Polished granite gleamed untouched. Water features ran without purpose, their choreographed arcs reflected in glass. No guest had yet smudged. Inside the lobby, staff in crisp uniforms waited at stations arranged for crowds that were not coming. The bellhops stood motionless. The concierge desks held no questions. Somewhere beyond the reception area, 3,644 rooms sat ready, beds turned down, minibars stocked, curtains drawn against light that would fall on no one. This wasn't a resort that failed over time. It failed the moment the doors opened. Was this a tragic miscalculation, or was it doomed from the moment it was imagined? When the resort officially opened, something was already wrong, and everyone felt it. The marketing had promised transformation. The largest resort opening Las Vegas had seen in years. Game changer. The next chapter in luxury hospitality. Videos showed glittering pools, celebrity chef restaurants, nightclubs where the future of Vegas nightlife would be written. The messaging was confident, insistent, relentless. The reality on opening day was quieter. Guests did arrive, enough to populate a fraction of the space. They checked in without delay because there were no lines. They rode elevators alone. They found restaurants open but half empty, staff outnumbering diners. The casino floor, designed to pulse with energy, felt cavernous. Slot machines chimed to empty aisles. Table games waited with dealers standing ready, cards shuffled, chips stacked, no players sitting down. Outside, the Strip moved past at its usual pace. Crowds flowed between Caesars and the Wynn, between Bellagio's fountains and Aria's sleek entrance. But the Fontainebleau sat slightly removed from the main artery, its positioning both prominent and somehow apart. Visible, but not quite in the path of natural foot traffic. Staff tried to maintain energy, smiles held, service stayed crisp. But in quiet moments, in the back corridors and break rooms, the same thought circulated. Where was everyone? The occupancy rate that first week hovered around 20%. For a property with 3,644 rooms, that meant roughly 2,900 rooms sat dark. Housekeeping walked floors where nothing needed cleaning. Room service prepared for orders that didn't come. The spa, built to accommodate hundreds, saw single-digit bookings. The silence was expensive. Every empty room represented lost revenue. Every unstaffed restaurant table was wasted payroll. The resort burned through operating costs designed for 70%, 80%, 90% occupancy, while actual guests filled barely a fifth of the space. The arithmetic was immediate and brutal. This wasn't a soft opening building toward capacity. This wasn't a seasonal lull or a temporary gap. This was opening day, the moment of maximum marketing push, maximum publicity, maximum expectation. And the building sat mostly empty. Something fundamental had gone wrong long before the doors opened. The question was when, and whether anyone had seen it coming. The idea was so luxurious that no one dared ask if it made sense. The Fontainebleau brand carried weight. The original Miami Beach property, opened in 1954, defined mid-century glamour. Frank Sinatra performed there. Presidents stayed there. The building's sweeping curves and Morris Lapidus design became iconic. The name meant something. Sophistication, history, a certain kind of American luxury that felt both aspirational and earned. Bringing that name to Las Vegas seemed logical. The Strip had room for another luxury property. The market was growing. High-end travelers were spending more. Competition between resorts drove innovation and spectacle. A new Fontainebleau could claim space alongside Wynn, Bellagio, and Aria. The pitch was seductive. Las Vegas needed a property that felt more refined than the themed mega resorts, more intimate than convention-focused towers, more sophisticated than party hotels. The Fontainebleau would deliver that. Modern design, celebrity partnerships, a focus on experience over spectacle. The language used to describe the project was careful. Press releases spoke of elevated hospitality, curated experiences, and sophisticated luxury. Renderings showed sleek interiors, infinity pools with strip views, restaurants helmed by Michelin-starred chefs. Everything looked perfect. The perfection itself should have been a warning. Luxury real estate, especially at this scale, rarely succeeds on aspiration alone. The vision has to align with demand. The target guest has to exist in sufficient numbers. The location has to support the concept. The timing has to be right. But when a project looks this polished in presentation, questioning feels like pessimism. Investors saw the renderings and believed. Lenders saw the brand name and approved. Partners saw the momentum and signed on. Everyone assumed someone else had done the hard analysis, the market research, the demand modeling that would prove the concept viable. The assumption was collective and wrong. The developers pushed forward with confidence that bordered on certainty. Las Vegas was resilient. The Fontainebleau name was strong. Quality would win. Build it right, and they will come. The logic felt sound because it was simple, and simplicity in real estate development often masks complexity that should be examined more closely. No one wanted to be the voice saying, "Wait, does Las Vegas actually need this? Is there demand for another 3,600-room luxury property? What happens if we're wrong?" Asking those questions would have required pausing. Pausing would have meant losing momentum. Losing momentum might have meant losing investors. The machine was already moving. The only direction was forward. And so the project moved forward, propelled by confidence, capital, and the collective belief that vision alone could create reality. The resort wasn't designed around people, it was designed around numbers. Jeffrey Sofer controlled Fontainebleau development. His family had built the original Miami property into an empire. He understood real estate, understood branding, understood how to move capital through complex deals. His track record included successful projects, high-profile partnerships, and a reputation for aggressive expansion. Sofer looked at Las Vegas and saw opportunity measured in square footage, room count, and revenue per available room. The Strip's luxury segment was growing. Average daily rates were climbing. Occupancy across top-tier properties stayed strong. The data, when viewed from 30,000 feet, suggested room for another player. The decision to build at 3,644 rooms reflected a specific logic. Smaller properties couldn't achieve the economies of scale needed to compete. Boutique resorts lacked conference space, lacked restaurant. Diversity lacked the critical mass to attract group bookings. To compete with Wynn and Bellagio, the Fontainebleau needed comparable size. Scale would also deliver negotiating power. Larger properties could command better terms from suppliers, entertainment acts, and convention organizers. More rooms meant more leverage. More leverage meant better margins. The math appeared sound. But scale makes one critical assumption: demand will fill the space. For that assumption to hold, the target guest has to exist. Not theoretically, not in aspirational market research. Actually exist, with wallets open and reasons to choose this property over established competitors. Sofer's confidence came partly from success elsewhere. The Miami Fontainebleau had been revitalized profitably. Other projects had worked. He had experience, capital, and a brand. In his view, execution mattered more than market timing. Build the best product, and the market would respond. The belief was genuine. It was also a gamble disguised as strategy. Real estate development at this scale doesn't allow for modest failure. You can't build 3,944 rooms and then decide to operate 2,000 of them while waiting for demand to catch up. The entire structure, financial and physical, is designed around full utilization. Debt service assumes occupancy. Operating costs assume revenue. Everything is leveraged against the assumption that guests will come. When they don't, the structure collapses quickly. SOFA moved forward with conviction. Investors followed that conviction. Lenders financed it. Contractors built it. And the assumption that scale could replace careful demand analysis went untested until opening day, when the empty valet lanes delivered their verdict. By the time construction began, the failure was already funded. The project's capital stack was complex: equity from Fontainebleau Development, debt from multiple lenders, mezzanine financing from private investors. The total investment approached $3.7 billion, making it one of the most expensive resort developments in Las Vegas history. The structure was typical for mega projects. Equity absorbed the first loss. Mezzanine debt sat in the middle. Higher risk, higher return. Senior debt, secured by the property itself, formed the foundation. If the project succeeded, everyone made money. If it failed, losses flowed upward through the capital stack, wiping out equity first, then mezzanine, then potentially reaching senior lenders. Raising $3.7 billion requires persuasion. Investors need to believe in returns. Lenders need to believe in repayment. The pitch relied on several key assumptions. First, Las Vegas was recovering from the 2008 financial crisis. Visitor numbers were climbing. Casino revenue was rebounding. The worst was behind the market, and growth looked sustainable. Second, the luxury segment was outperforming. While mid-tier properties struggled, high-end resorts saw strong occupancy and rising rates. Wealthy travelers were spending. The Fontainebleau would capture that spend. Third, the brand carried value. The Fontainebleau name was recognized. It suggested quality and history. Marketing could leverage that recognition into bookings. Fourth, Las Vegas had a structural advantage. No other U.S. market combined gaming, entertainment, conventions, and nightlife at this scale. Demand wasn't going away. The city was resilient. These assumptions were not fabricated. Each had supporting data. But data can mislead when context is ignored. The recovery from 2008 was real but uneven. Luxury properties were performing well, but they were also increasingly competitive. Each new opening fragmented the market further. The Fontainebleau would enter a segment where established players, Wynn, Bellagio, Aria, already had loyal guests and operating efficiencies. The brand recognition was real, but not universal. The Miami property was iconic to a generation that remembered 1960s and 1970s glamour. Younger travelers, the demographic Las Vegas increasingly targeted, had less emotional connection to the name. Location mattered more than the pitch acknowledged. The Fontainebleau sat on the north end of the Strip, past the Wynn, slightly removed from the densest cluster of resorts. Not isolated, but not central. In Las Vegas, location dictates foot traffic. Foot traffic drives gaming revenue. Gaming revenue subsidizes everything else. A property off the main path has to work harder to attract guests. None of these concerns stopped the money. Capital in the 2010s was cheap and abundant. Interest rates were low. Investors chased yield. Real estate, especially branded real estate in a resilient market, looked safe. The risks were acknowledged in footnotes but dismissed in practice. Construction began in earnest around 2021. The site transformation was dramatic. Cranes rose, steel framed the tower, glass wrapped the exterior. Interior work followed: wiring, plumbing, HVAC, systems, finishes. Thousands of workers moved through the site daily. The scale was visible from anywhere on the Strip. By 2023, the building was ready. Certificates of occupancy were filed. Staff was hired and trained. Restaurants were stocked. The marketing campaign launched. Everything was in place except the one element no amount of capital could manufacture: guests who wanted to come. The money had arrived before reality. And reality was patient. The numbers defined the ambition and the risk. $3.7 billion in total investment made the Fontainebleau one of the most expensive resort projects in U.S. history. The building rose 67 stories and contained 3,644 rooms, making it the largest new hotel construction Las Vegas had seen in over a decade. Square footage exceeded 1.2 million across hotel towers, casino floor, retail space, and amenities. The property included 36 restaurants and bars, a 55,000 square foot spa, 550,000 square feet of convention space, and a 96,000 square foot casino. Expected occupancy at stabilization was modeled at 85%, generating roughly 3,100 occupied rooms per night. Average daily room rates were projected at $400, producing annual room revenue near $450 million. Casino revenue was estimated at $200 million annually. Food, beverage, and entertainment were expected to add another $300 million. Total projected annual revenue approached $1 billion. Debt service on $2.5 billion in borrowing, assuming a blended rate near 6%, required approximately $150 million annually. Operating expenses for a property this size typically run 60% to 70% of revenue, or $600 million to $700 million per year. That left a narrow margin for error. The financial model assumed the property would reach stabilized occupancy within 18 months. Ramp-up periods are normal. New resorts take time to build awareness and loyalty, but 18 months of below-target occupancy meant 18 months of losses. The model had room for that, barely. What it didn't have room for was opening at 20% occupancy with no clear path to improvement. The ideal guest existed on paper, not in real life. The target demographic was carefully defined: affluent travelers, household income above $200,000, age 35 to 55, interested in sophisticated experiences, not theme park spectacle, willing to pay premium rates for quality, service, and design. The kind of guest who stayed at the Wynn or Bellagio but might be lured by something newer, fresher, more refined. This guest made sense in theory. Las Vegas attracts millions of high-income visitors annually. The luxury segment is real and substantial. Capturing even a modest share of that market would fill 3,744 rooms. But theory requires precision. The actual guest has to choose this property over alternatives. That choice depends on dozens of variables: location, brand loyalty, amenities, price, reviews, availability, and intangible factors like reputation and social proof. The Fontainebleau faced challenges in each category. Location worked against it. The north end of the Strip is accessible but not central. Guests walking from Caesars or Bellagio wouldn't pass the Fontainebleau. Foot traffic, the lifeblood of casino revenue, required intentional travel. That meant guests needed a reason to come. The property itself had to be the destination, not a convenience along the way. Brand loyalty favored competitors. The Wynn had cultivated a devoted following over nearly 2 decades. Bellagio's fountains and art gallery were iconic. Aria attracted younger travelers with modern design and technology. Each of these properties had history, reputation, and a clear identity. The Fontainebleau had a Miami legacy, but that legacy didn't automatically transfer to Vegas. Pricing created another barrier. To justify $3.7 billion in investment, room rates had to stay high. But high rates require demonstrable value. A guest choosing between a $350 room at Bellagio and a $400 room at Fontainebleau needs a compelling reason to pay more. Better views? Newer design? Superior service? Without clear differentiation, price becomes a disadvantage. Reviews didn't exist at opening. Trust in hospitality relies heavily on social proof. Travelers read TripAdvisor, Yelp, Google reviews before booking. Established properties have thousands of reviews establishing reputation. A new property starts at 0. Early reviews matter enormously, and early reviews for the Fontainebleau were mixed. Guests noted empty spaces, inconsistent service, and a sense that the property was still finding its rhythm. The ideal guest the project was designed for, sophisticated, affluent, willing to pay premium rates, did exist. But that guest had options. Lots of options. And nothing about the Fontainebleau's opening suggested it offered something those options didn't already provide. The mismatch wasn't obvious until guests didn't show up. Market research had identified the demographic. Surveys suggested interest, focus groups, responded positively to renderings, but none of that measured actual booking behavior. The gap between stated preference and revealed preference is where many projects fail. The Fontainebleau had built for a guest who said they wanted something new. What it needed was a guest who actually booked a room. The difference proved decisive. Every upgrade made the project look safer and made it weaker. As construction progressed, decisions accumulated. Each decision made sense in isolation. Each added cost. Together they pushed the project further from viability. The lobby was redesigned twice. The first design felt too understated, the second too busy. The third version, finalized and built, featured imported marble, custom lighting fixtures, and a sculptural centerpiece that cost 7 figures. It looked stunning. It also added months to the schedule and millions to the budget. Restaurants became showcases, celebrity chefs were recruited, kitchens were built to their specifications. Dining spaces received custom furniture, curated art, and design details that signaled quality. Each restaurant was a statement. Each statement was expensive. The pool complex expanded during development. Initial plans called for a large pool deck with standard amenities. Competitive analysis suggested that wasn't enough. Rivals had multi-level pool experiences, cabanas with dedicated service, and Instagram-ready design. The Fontainebleau's pool was reimagined as a multi-tiered resort within the resort. Waterfalls, private cabanas, poolside bars, VIP sections. The final version was spectacular. It also required additional structural support, more staffing, and higher maintenance costs. Technology was integrated throughout. Guests could control room lighting, temperature, and entertainment through tablets. Check-in could happen via app. The casino floor featured the latest slot machines and table management systems. Every tech upgrade promised efficiency and enhanced experience. Each also required custom installation, ongoing software updates, and technical staff to maintain systems. This pattern, enhancement layered on enhancement, reflects a common dynamic in large developments. As a project progresses, stakeholders see competitors' offerings and insist on matching or exceeding them. Bellagio has this, so we need that. Wynn offers this experience, so we need something better. The logic is competitive and relentless. But each upgrade has financial implications. Construction costs rise, operating complexity increases, the break-even threshold climbs. A property that could have been profitable at 70% occupancy now requires 85%. A property designed to generate returns with $300 rooms now needs $400. The gold plating problem is structural. Once a project reaches a certain scale and visibility, cutting costs feels like failure. Investors have already committed billions. Lenders have approved financing. Marketing is underway. The momentum is forward, and forward means better, more refined, more competitive. No one wants to be the person who says, "This is good enough." Good enough sounds like settling. In luxury hospitality, settling is death. So the enhancements continue, the budget expands, the timeline stretches, and the final product, undeniably beautiful, becomes financially fragile. Every dollar spent improving the guest experience is a dollar that must be recovered through revenue. When revenue falls short, those improvements become liabilities. The Fontainebleau at opening was objectively impressive. The design was cohesive. The finishes were high quality. The amenities were competitive. It looked like exactly what it was intended to be, a world-class luxury resort. It just couldn't pay for itself. There was no rush, only silence. The first weeks of operation are critical for any new resort. This is when publicity peaks, when curiosity drives bookings, when the property has its best chance to build momentum. Opening strong creates positive reviews, social media buzz, and word of mouth that sustains future bookings. The Fontainebleau's opening was soft in every sense. Occupancy stayed low, marketing pushed hard, offering promotions, partnering with influencers, buying ad space. Some guests responded, but not enough, not nearly enough. The property that needed to average 3,100 occupied rooms per night was barely reaching 700. The casino floor suffered especially. Gaming revenue in Las Vegas depends on foot traffic and repeat players. The Fontainebleau's location made foot traffic difficult, and repeat players, the locals and regulars who sustain casino operations, gravitate toward established properties with known odds, familiar dealers, and accumulated loyalty points. A nearly empty casino floor creates a psychological barrier. Gamblers avoid dead casinos. The energy matters, the sound of slot machines, the density of players at tables, the sense that action is happening, all of this draws more players. An empty floor repels them. Restaurants faced similar challenges. Even acclaimed chefs struggle when dining rooms are half empty. Service suffers because staff-to-guest ratios are too high. The atmosphere feels off. Diners notice. They post reviews mentioning empty tables and awkward quiet. Those reviews discourage future bookings. The spa, designed to accommodate hundreds, saw single-digit daily appointments. The fitness center was underused. The pool, spectacular and expensive, attracted modest crowds even on weekends. Every amenity space felt too large for the number of guests present. Staff morale began to erode. Hospitality workers thrive on interaction. Busy shifts pass quickly. Empty shifts drag. Employees standing idle for hours while payroll burns question whether their jobs are secure. Rumors circulate. Turnover begins. Management tried to project confidence. Internal memos emphasized that ramp-up takes time. Promotions were adjusted. Partnerships with travel, agencies, and corporate booking platforms were pursued. The message was clear: stay the course, momentum will build. But momentum requires forward movement. The Fontainebleau wasn't moving forward. It was treading water, burning capital every day, while occupancy stayed stubbornly low. The first months of a new resort should feel electric. Staff should be overwhelmed with work. Systems should be tested and refined under real demand. Problems should emerge and be solved in real time. The energy should be palpable. At the Fontainebleau, the energy was absence. The building was ready, the guests were not coming, and the daily cost of that absence was staggering. The resort didn't fail because it was empty. It failed because it was expensive. Operating a 3,644-room luxury resort requires infrastructure that runs whether guests are present or not. The costs are largely fixed, and they are enormous. Staffing was the largest line item. The property employed roughly 4,000 people at opening. Housekeepers, front desk agents, bellhops, valets, casino dealers, restaurant servers, cooks, bartenders, security guards, engineers, maintenance workers, managers, executives. Payroll alone approached $15 million per month. Utilities followed. Keeping a building this size lit, heated, cooled, and supplied with water costs millions monthly. The HVAC systems ran continuously. Electricity demand never stopped. Water for pools, landscaping, kitchens, and thousands of guest bathrooms added up quickly. Maintenance was constant. A structure this new shouldn't require heavy repairs, but routine upkeep is unavoidable. Light bulbs burn out. Filters need replacing. Equipment requires servicing. Landscaping demands attention. Small issues compound quickly at this scale. Supplies represented another steady drain. Linens, toiletries, cleaning products, kitchen inventory, bar stock, paper goods. A hotel this size consumes supplies at an industrial rate. Even with bulk purchasing and supply chain optimization, monthly costs ran into 7 figures. Marketing and sales required ongoing investment. Advertising, partnerships, promotional rates, commissions to booking platforms. Driving awareness and bookings in a competitive market like Las Vegas costs money continuously. Debt service was the heaviest burden. With $2.5 billion in borrowing at a blended rate around 6%, monthly interest payments approached $12 million. That money had to be paid regardless of occupancy. It was non-negotiable. The break-even calculation was straightforward but unforgiving. To cover operating costs and debt service, the property needed roughly $80 million in monthly revenue. With 3,644 rooms, that required averaging about $730 in revenue per available room per night, a metric known as RevPAR. Achieving $730 to RevPAR required either very high occupancy at moderate rates or moderate occupancy at very high rates. The ideal scenario was 85% occupancy at $350 average daily rate, plus strongs, casino, food, beverage, and entertainment revenue. At opening, occupancy was 20%. Average daily rate was discounted to attract guests, hovering around $280. RevPAR was barely $55. Monthly revenue was closer to $20 million. The shortfall was $60 million per month. Every month, that gap could not be sustained. Equity would be exhausted within months. Mezzanine lenders would face losses. Senior debt would be at risk. The financial structure had no cushion for prolonged underperformance. The hidden costs weren't hidden to anyone who looked carefully. They were simply assumed to be covered by revenue that would materialize. When that revenue didn't come, the costs became existential. The daily arithmetic was brutal. Operating a 3,644-room resort required approximately $2.6 million daily to cover payroll, utilities, supplies, marketing, maintenance, insurance, and debt service. That figure assumed optimized operations and didn't include capital expenditures or reserve funds. To generate $2.6 million daily required $80 million monthly, or roughly $950 million annually. Breaking that into components, room revenue needed to contribute $450 million, requiring 85% occupancy at $350 average daily rate. Casino revenue had to hit $200 million annually, about $550,000 daily. Food, beverage, retail, and entertainment needed to add another $300 million, or roughly $820,000 daily. At opening, actual performance was far short. With 20% occupancy, approximately 730 rooms were occupied nightly. At a discounted rate of $280, room revenue was about $200,000 daily, or $6 million monthly. Casino revenue was anemic, perhaps $100,000 daily. Food and beverage revenue from mostly empty restaurants added maybe another $150,000 daily. Total daily revenue hovered around $450,000. Total daily costs were $2.6 million. The daily loss was $2.1 million. Over a month, that was $63 million. Over a quarter, nearly $190 million. The property had perhaps $150 million in liquid reserves to absorb losses during ramp-up. At the current burn rate, those reserves would be exhausted in under 10 weeks. After that, debt default was inevitable. The financial model had assumed losses during the first 12 to 18 months, but losses of $10 million to $15 million per month, not $60 million. The model had assumed occupancy would climb steadily from 50% at opening to 85% within 18 months. Instead, occupancy was 20% with no clear growth trajectory. The gap between projected and actual performance was not a rounding error. It was a fundamental mismatch between expectation and reality. When revenue stalled, everyone looked for someone else to blame. The first target was marketing. The campaigns hadn't been aggressive enough. The messaging wasn't resonating. Influencer partnerships were poorly chosen. The budget needed to be increased. More ads, better targeting, stronger promotions. If awareness was the problem, awareness could be bought. Marketing teams pushed back. The campaigns had reached millions. Social media engagement was solid. The problem wasn't awareness. People knew the Fontainebleau existed. They just weren't booking. Attention turned to sales. The corporate sales team wasn't closing group bookings fast enough. Convention business, a major revenue driver, was underperforming. Contracts with event planners needed to be more aggressive. Rates needed to be more competitive. Sales teams argued that corporate clients were hesitant because the property was unproven. Convention organizers wanted track records. They wanted testimonials from previous events. The Fontainebleau had neither. Winning corporate business takes time. Operations became the next scapegoat. Service was inconsistent. Staffing levels were wrong. Training was inadequate. Guests were noticing problems, posting negative reviews, and discouraging future bookings. Fix the experience, and bookings would follow. Operations countered that service was constrained by occupancy. Training works best under real conditions with real guests. An empty property can't simulate the rhythms of full occupancy. Staff were doing their best with the guests who were there. Then the finger pointed at pricing. Room rates were too high. Competitors offered better value. The property needed to discount more aggressively to build market share first, worry about margins later. Finance resisted. Discounting eroded revenue. Lower rates meant filling more rooms to hit the same revenue targets. With occupancy already abysmal, slashing prices would just make losses worse. Location was raised as an issue. The north end of the Strip was the problem. Foot traffic was always going to be limited. The property should never have been built here. This was a site selection failure from the beginning. Development teams pointed out that the location had been analyzed extensively. Competitors nearby, especially Wynn, were profitable. The issue wasn't the site, it was execution. The cycle of blame was predictable and unproductive. Every department had legitimate explanations for underperformance. Every explanation pointed to factors outside their control. No single issue was the problem, which meant no single fix would work. What none of the blame-shifting addressed was the fundamental question. Did Las Vegas need this property? Was there actual demand for another 3,644 luxury rooms in a market that already had ample high-end supply? Had anyone, at any point, rigorously tested whether the target guest existed in numbers sufficient to sustain this scale? The answer was uncomfortable. Market research had been conducted, but it was optimistic. Assumptions had been made, but they were generous. The project had moved forward on confidence, not certainty. Blaming individuals or departments was easier than acknowledging a systemic failure in judgment. So the blame continued to circulate while occupancy stayed flat and losses mounted. They didn't announce closures. They just stopped opening things. 3 months after opening, the spa reduced operating hours. Instead of 7 a.m. to 10 p.m., it opened at 9 a.m. and closed at 7 p.m. Fewer hours meant fewer staff. Fewer staff meant lower payroll. The decision was practical, but it sent a signal. The property was contracting. Several restaurants shifted to limited schedules. Fine dining concepts that were supposed to operate nightly moved to Thursday through Saturday only. Breakfast service in some venues was eliminated. Guests were directed to fewer, more centrally located options. Again, practical. Again, a signal of struggle. The pool complex, expensive to operate with lifeguards, attendants, and bar service, closed sections during weekdays. Cabanas that were supposed to be premium offerings sat unused and roped off. Entire floors of the hotel tower went dark. With occupancy so low, concentrating guests on fewer floors made operational sense. Housekeeping could focus efforts. Energy costs could be reduced. But walking through a hotel where entire floors are locked and unlit creates an eerie atmosphere. Guests noticed. These adjustments were never formally announced. No press releases, no explanations. Services just quietly contracted. Hours changed. Amenities became unavailable. The resort that had promised comprehensive luxury was revealing itself to be selectively available. Staff cuts followed. Layoffs were handled in waves to avoid panic. But word spread quickly. Housekeepers, restaurant servers, dealers all heard rumors, then received notices. Some departments lost 20% of headcount, others more. The cuts were necessary to slow the bleeding, but they created a downward spiral. Fewer staff meant longer wait times. Longer wait times meant poorer service. Poorer service meant more negative reviews. More negative reviews meant fewer future bookings. Maintenance began to slip. Small issues that would have been addressed immediately were delayed. A flickering light in a hallway stayed unfixed for days. A stain on carpet in a public area remained. Landscaping started to look slightly less manicured. None of these were catastrophic, but together they signaled decline. Guests sensitive to such things, and luxury travelers tend to be, noticed. The resort felt like it was struggling, and once that perception set in, it became self-reinforcing. The quiet shutdowns were a form of managed retreat. The property was too large for the demand it was actually seeing. Rather than admit failure publicly, management tried to scale back invisibly. Operate fewer spaces. Employ fewer people. Spend less while waiting for occupancy to improve. But occupancy wasn't improving. The closures, subtle as they were, accelerated the perception that the Fontainebleau was in trouble. And perception in hospitality is reality. This is where the story splits and never fully recombines. Some argued the failure was timing. The project opened as economic conditions were shifting. Inflation was rising. Interest rates were climbing. Consumer confidence was softening. Travel spending, especially discretionary luxury travel, was becoming more selective. A property that might have thrived in 2019 struggled in 2023. This explanation had merit. Macroeconomic conditions matter enormously in hospitality. Luxury resorts are the first to feel downturns. When budgets tighten, travelers trade down. They choose mid-tier properties over high-end. They shorten trips. They skip Vegas altogether. But timing alone couldn't explain 20% occupancy. Other luxury properties on the Strip maintained solid performance. Wynn, Bellagio, and Aria reported occupancy above 80% during the same period. The market for luxury travel in Las Vegas still existed. It just wasn't choosing the Fontainebleau. Others argued location was the problem. The north end of the Strip, past Wynn, was too far from the action. Guests gravitate toward density. They want to be near multiple options, restaurants, shows, casinos, shopping. The Fontainebleau required intentional travel. That was a structural disadvantage no amount of marketing could overcome. This explanation also had truth. Location matters immensely. Properties closer to the center of the Strip benefit from natural foot traffic. The Fontainebleau's position was viable, proven by Wynn's success nearby, but it required the property to be a destination. Guests had to have a reason to go there specifically. Without differentiation, location became a liability. A third camp blamed brand confusion. The Fontainebleau name meant something in Miami. It meant less in Vegas. Travelers familiar with the Miami property might have expectations the Vegas version didn't meet. Travelers unfamiliar with the brand had no emotional connection. The name recognition that seemed like an asset might have been neutral or even negative. Market saturation offered another explanation. Las Vegas had added thousands of luxury rooms in the previous decade. Aria, Cosmopolitan, and others had expanded capacity. The luxury segment was crowded. Adding 3,744 more rooms into an already saturated market was simply too much supply, chasing finite demand. This argument was compelling. Supply and demand must balance. If supply exceeds demand, occupancy falls and rates compress. The Fontainebleau entered a market where capacity might have already reached or exceeded sustainable levels. Finally, some pointed to execution. The property was beautiful but lacked a clear identity. It wasn't the most luxurious. It wasn't the most innovative. It wasn't the best value. It was very good at several things, but exceptional at none. In a competitive market, being very good isn't enough. Each explanation had supporting evidence. Each could be countered with exceptions or alternative interpretations. The truth, frustrating and complex, was that all of these factors likely contributed. Timing was bad, but not catastrophic. Location was challenging, but not impossible. Brand recognition was mixed, but not fatal. Market saturation was real, but not absolute. Execution was solid, but not distinctive. The failure was not a single decisive error. It was an accumulation of marginal disadvantages that, together, created a property the market didn't need. The ambiguity was uncomfortable. It resisted simple lessons. It couldn't be reduced to, they should have done X. The Fontainebleau failed because it was built on assumptions that proved slightly wrong in multiple dimensions simultaneously. And in real estate, slightly wrong is often enough. The revenue collapse was measurable and accelerating. Projected annual revenue at stabilization was $950 million. Actual revenue over the first 6 months was tracking toward $240 million annually, a 75% shortfall. Room revenue, projected at $450 million annually, was running at $72 million. Casino revenue, projected at $200 million, was barely reaching $36 million. Food, beverage, and entertainment, projected at $300 million, were combining for $132 million ROI. Time from opening to visible financial distress was 8 weeks. By week 8, management acknowledged internally that current performance was unsustainable. Reserves were being consumed at $60 million per month. At that rate, liquidity would be exhausted by month 4. Cash reserves, initially $150 million, had been drawn down to $30 million by the end of month 3. Emergency lines of credit, totaling $50 million, were tapped to meet payroll and debt service obligations. By month 4, those lines were fully drawn. Default notices from senior lenders arrived in month 5. Mezzanine lenders began negotiating either immediate repayment or foreclosure timelines. Equity holders, who had invested $1.2 billion, faced complete wipeout. The property's fair market value, assessed for potential sale or restructuring, was estimated at $1.8 billion to $2 billion, well below the $3.7 billion invested. The loss, even in a structured sale, would exceed $1.5 billion. Conversations with potential buyers began quietly in month 6. Offers, when they came, were lowball. Distressed assets trade at steep discounts. The property's operating losses made it toxic. No buyer would assume existing debt at face value. Restructuring was inevitable, and restructuring meant losses for nearly everyone involved. The calls stopped first. Then the funding. Investor relations had been tense since month 2. Conference calls shifted from optimistic updates to damage control. Management presented recovery plans, cost-cutting initiatives, marketing pivots, strategic partnerships. Every plan assumed occupancy would improve. None explained how. By month 4, investor patience was exhausted. Questions on calls became pointed. When will occupancy hit break-even? What is the plan if it doesn't? How long until liquidity runs out? Management's answers were increasingly vague. We're confident trends will improve. Early indicators suggest momentum building. We remain committed to the long-term vision. The language of distressed assets is euphemistic and polite until it isn't. By month 5, euphemism ended. Investors demanded transparency. Lenders required weekly cash flow reports. Restructuring advisors were brought in quietly to assess options. The options were limited and all painful. Option 1. Find new equity. Convince new investors to inject capital, allowing the property time to reach stabilization. This required believing that the problem was temporary and solvable. Few believed that. Option 2. Negotiate with lenders. Extend maturities, reduce interest rates, convert debt to equity. This required lenders accepting losses. Senior lenders might negotiate. Mezzanine lenders, already facing losses, were less flexible. Option 3. Sell the property. Accept a loss, exit the investment, let someone else take over. This required a buyer willing to acquire a distressed asset. Buyers in that market demand discounts of 30% to 50%. The loss would be massive. Option 4. File for bankruptcy protection. Restructure under court supervision, impose losses on creditors in order of priority, and emerge with a cleaner balance sheet. This was the option of last resort, but often the most realistic. Management resisted bankruptcy. The stigma would damage the brand. Operations would be disrupted. Key staff would leave. But resistance requires alternatives, and alternatives were vanishing. By month 7, investor calls became conference calls with legal teams present. The tone shifted from strategic to procedural. Discussions centered on liability, covenants, and legal protections. The project had moved from struggling business to failing enterprise. The silence came gradually. First, enthusiastic investors stopped responding to emails. Then passive investors stopped asking questions. Finally, lead investors, the ones who had championed the project, went quiet. They were calculating losses and consulting attorneys. Capital follows confidence. When confidence evaporates, capital disappears. The Fontainebleau had consumed $3.7 billion and generated perhaps $40 million in revenue before the money stopped. No one was willing to fund further losses. The moment investors went silent was the moment the project's fate was sealed. Luxury doesn't decay loudly. It fades. 6 months after opening, the Fontainebleau looked almost the same. The exterior was still striking. The lobby still gleamed. The architecture was unchanged. But something was missing. The energy, the sense of life. A luxury resort should feel alive. Guests moving through lobbies, laughter from restaurants, music from bars, the hum of slot machines, the clatter of dice. Energy is intangible but essential. When it's absent, a property feels hollow. The Fontainebleau felt hollow. Empty hallways amplified footsteps. Vacant conference rooms echoed. The casino floor, designed for crowds, looked cavernous with a few. Scattered players. Restaurants operated with skeleton crews. The pool, beautiful and expensive, reflected sky and clouds with almost no ripples from swimmers. Security remained. Cameras watched, guards patrolled. The property was safe. But safety in hospitality is table stakes. Guests expect it. They don't book based on it. What they book for is experience, and experience requires other guests. Maintenance began to show neglect. Small things at first. A light bulb out in a hallway. A smudge on glass that went unwiped. A plant in the lobby looking slightly wilted. These details multiply. Together they signal decline. Staff morale was visible. Employees moved through motions without energy. Smiles were polite, but tired. Conversations were brief. The enthusiasm of opening day had been replaced by quiet resignation. The property was in a strange state. Not abandoned, but not thriving. Still operating, but barely. The physical structure remained sound. The systems functioned. But the life a resort needs to justify its existence was missing. This is what failure looks like in real time. Not dramatic collapse, but slow erosion. Revenue falling short. Staff being cut. Services contracting. Energy dissipating. The building standing, beautiful and mostly empty, waiting for a resolution that kept being delayed. What remains when luxury leaves is a shell. Impressive from the outside, hollow inside, a structure that cost billions, built to house thousands, serving hundreds, losing millions. And the question hanging over everything, what happens next? This resort wasn't unique. It was a pattern. The Fontainebleau joined a long list of mega-resort failures. City Center in Las Vegas opened during the 2008 financial crisis, struggled for years, and required restructuring. Revel in Atlantic City opened in 2012, closed in 2014, and was sold for pennies on the dollar. Numerous casino projects across the US have followed similar trajectories: ambitious vision, enormous capital, poor timing, insufficient demand, financial collapse. The pattern persists because the incentives are misaligned. Developers make money during development, fees for managing construction, profits from land transactions, salaries and bonuses tied to project completion, not operational success. By the time a property opens and its performance becomes clear, developers have already extracted value. Investors chase yield in low-interest environments. When money is cheap, risk tolerance increases. Projects that wouldn't be financed during high-rate periods look attractive. The search for returns drives capital into deals that are marginally viable at best. Lenders rely on appraisals that assume successful operations. Appraisers use comparable properties to estimate value. If comparables are performing well, the new project is valued optimistically. The possibility of underperformance is acknowledged but discounted. Market research firms deliver findings that clients want to hear. Developers seeking positive data can find analysts willing to provide it. Surveys can be structured to yield optimistic results. Assumptions can be tuned to make models work. The incentive is to produce research that justifies the project, not research that questions it. Media amplifies hype. New resort openings generate coverage. Renderings circulate. Interviews with developers emphasize vision and confidence. Skeptical voices are rare because they don't drive engagement. Positive stories attract readers. Critical analysis is less appealing. The result is a cycle where ambitious projects are proposed, financed, built, and opened based on optimism rather than rigorous demand analysis. Some succeed because timing, location, and execution align. Many fail because one or more of those elements doesn't work. The Fontainebleau failed because scale was prioritized over demand, because vision was mistaken for strategy, because confidence replaced caution, because everyone involved had incentives to move forward and few incentives to pause and question. The lesson, repeated across decades and industries, is that large-scale real estate development is unforgiving. Margin for error is small. Assumptions must be conservative. Demand must be proven, not assumed. When those principles are ignored, failures follow. Yet the pattern persists, because the rewards for those who get it right are enormous, and the costs of failure are borne by investors and lenders, not typically by the developers who initiated the projects. The failure wasn't architectural, it was philosophical. The Fontainebleau was beautiful. The design was coherent. The construction was sound. The finishes were high quality. Every physical element was executed well. The failure was not in what was built, but in the decision to build it at all. The lesson is uncomfortable. Beauty and quality do not guarantee demand. A hotel can be stunning and fail. A resort can offer exceptional service and go bankrupt. Excellence in execution does not compensate for errors in conception. The philosophical error was believing that supply creates demand. If you build something impressive enough, guests will come. But hospitality doesn't work that way. Guests come because they have a reason. Location, value, reputation, convenience, loyalty. They don't come because a building is tall or finishes are expensive. The second philosophical error was trusting scale to solve problems. Bigger is not inherently better. Larger properties have economies of scale, but they also have enormous fixed costs. A 500-room boutique hotel can be profitable at 60% occupancy. A 3,644-room mega resort requires 80% plus to survive. Scale magnifies both success and failure. The third error was confusing confidence with analysis. Confidence is essential in development. Projects require conviction. But confidence must be grounded in data. Markets must be studied. Demand must be quantified. Assumptions must be tested. When confidence becomes a substitute for analysis, failure is likely. The final error was ignoring constraints. Every market has limits. Supply cannot exceed demand indefinitely. Wealth is finite. Travel budgets are finite. Las Vegas can absorb new luxury capacity, but not infinitely. The question is where the limit is and whether a new project fits within it. No developer wants to learn this lesson because it requires accepting limits. It requires saying, this market can't support my vision. It requires walking away from projects that look great on paper. It requires humility and caution in an industry that rewards boldness and ambition. The Fontainebleau's failure will be studied in business schools. Case studies will dissect the decisions. Students will identify errors and propose alternatives. The analysis will be clear in hindsight. But the next mega project is already being pitched somewhere. Renderings are being refined. Investors are being courted. Lenders are reviewing proposals. And the same errors, dressed in different details, are likely being made again. Because the incentives haven't changed. Because confidence still sells. Because the rewards for success remain enormous. And because the lesson no developer wants to learn is the one that keeps needing to be taught. The Fontainebleau failed not because it was built poorly, but because it was built at all. Wealth does not create demand. Vision does not guarantee occupancy. And scale, without strategy, is simply expensive failure. The valet lanes are still empty. The lobby still gleams. And the building waits, beautiful and mostly dark, for a future that may never arrive.